Welcome to How to Make Money in Stocks with Investors Business Daily, featuring market commentator and host of the IBD Market Wrap, Amy Smith, and Matthew Galgani, host of the IBD Stock Analysis and editor of the IBD Extra newsletter. Tune in each week as we use history, not hunches, to help you stay safe in today's market and get in early on tomorrow's winning stocks. Now, here's Matthew Galgani.
Welcome, everyone, to another episode of How to Make Money in Stocks with Investors Business Daily. We want to let you know that the latest special report that features new buys by the top-performing stock funds, and new sells, actually, has just come out, and you'll find a link to that at investors.com/investingshow.
And today on the show, we're going to talk about how important the moving averages are. But first, let's take a look at the market. It was another yo-yo week as Greece and China sent jitters through the market, but the market reacted positively on Friday to what looks like will be some sort of a settlement. We don't know what, something with Greece over its debt crisis. We had the Chinese markets really sold off harshly. They rebounded, though. That lifted investor confidence. We still remain in this choppy environment without a really solid trend in place. We do have earnings ramping up again. We start off next week. There's a lot of stocks reporting that could change things either positively or negatively, depending on how the majority of companies report. Now, the higher dollar is expected to have an impact on some of these companies.
And one thing to keep an eye on in terms of earnings next week are the big banks are reporting. You've got JP Morgan Chase, Bank of America, Goldman Sachs, and Citigroup all reporting next week, as well as Netflix. And that stock has been acting well, so it'll be interesting to see what kind of numbers it reports and how the market reacts.
And we had Janet Yellen, said she's the Fed chair, of course, said that a rate hike will probably be needed later this year. We still have 6 distribution days on the S&P. We've got 5 on the NASDAQ. We're going to talk about the moving averages today. Take a look at Apple. Came down to the 200-day and took a nice little bounce. Netflix is finding support at the convergence of the 10 and the 21. As Matt said, they report next week. And Amazon found support at the 50-day.
If you go through the IBD 50, again, it's a mix of a lot of stocks testing these key benchmark lines, some of them holding up very well, a few still in bases. And you can see all that by looking at the mini charts inside of the IBD 50. But there have been some pullbacks among some leaders in different industries like cybersecurity. CyberArk and Vasco Data Security both ran into some trouble. And also some of the chip stocks like Skyworks and Avago have pulled back. They seem to be trying to hold in there, so we'll see how that plays out.
Now, Matt and I have covered some stocks in our videos this week. I've covered Ulta, which broke out. That had a nice week. I covered Walgreens. That was another one that's done well. I took a look at Hasbro. Both Matt and I looked at Lennar. Cracker Barrel, Texas Roadhouse, and Yum Brands are all at least having on your watch list because they are behaving fairly well in the market.
Imagine a Sunday morning, coffee in hand, you turn on your laptop or tablet and you see a handful of stocks near a potential buying range. That's what you get with Leaderboard from IBD, a timely watch list put together by our market experts, and it's updated throughout the week with alerts to any buy or sell signals. The results? In 2013, Leaderboard has more than tripled the performance of the S&P 500. So to see what's on the list right now, get a free trial of Leaderboard at investors.com/radio show. That's investors.com/radio show. Now, back to How to Make Money in Stocks with Investors Business Daily.
So we all know that learning to read charts is a very important part of learning how to invest. In fact, IBD founder Bill O'Neill always talks about how learning to read charts is the most important investing skill that you will ever learn. Now, one of the keys to reading charts is to understand moving averages. So today we're going to talk about how you can use different moving averages like the 10-week line or the 50-day line to gauge the health of your stocks. In the first segment, we're going to focus more on how to use these moving averages as lines of defense and how you can see if your stock is finding or losing support. And then in the second segment, we'll talk more about what to do if your stock is doing very well and is way above these moving average lines.
Which, of course, is a nice problem to have.
It's a nice problem to have, but you do have to understand what that is telling you.
Now, in the recent market, we've seen the major indexes struggling with the 50-day. The NASDAQ is below it. So is the S&P. So is the Dow. And the S&P and the Dow have had some troubles around the 200-day line. They've fallen below that line. Then they bounced above it this week. Again, kind of that yo-yo action. Only what we're seeing is, first you saw the break of the 50. Mm-hmm. Well, then you get down, you see the break of the 200, and that's a place usually where even, the pros will come in to even support the major indexes. When we're in a better market, you're going to see a strong uptrending move. Well, if you're looking at a chart, a longer-term chart, you're going to see the 50-day line. If you take a look at a weekly chart, you're going to see, of course, the 10-week line. And we have not seen a real trend for some time. We have been in this choppy environment for really quite some time.
So let's step back for a second and talk about what are moving averages. Well, just like the name implies, it's simply the average price over that trailing period that's specified. And the most common periods are on the weekly chart, you'll see the 10-week moving average and the 40-week moving average. And on a daily chart, you'll see the 50-day and the 200-day line. Many people will also use, say, a 10-day line and a 21-day line, as well as shorter-term indicators. Now, these moving averages are important for a couple of reasons. One is it helps you visually put into context the fluctuations that just typically happen day to day, week to week. And that helps you see how your stock or the indexes are doing relative to these longer-term trends and see if they're finding support or resistance. The second reason is that the professionals use these lines, the big institutional investors like fund managers, pension fund managers, and others. So when we talk about a stock finding support or not finding support at, say, the 50-day or the 10-week moving average line, we're talking about whether or not these large fund managers and other investors are coming in to support their positions or add shares, because they're looking at these lines as sort of like a line in the sand, and they don't want the stocks to fall below that.
Well, yeah, if you have several $1 million as a position in a stock and you see it coming down to perhaps the 50-day, you are going to step in there and support your position. If you're a big fund, throw some more money into it because you don't want that price to drop lower. You're actually trying to support your position.
Right, and if the stock does go below those lines on really heavy volume, that's telling you that these fund managers are getting out of that stock. They're not stepping in to support it.
All right, now with individual stocks, a trip to the 50-day can mean many things. Let's say that a stock is breaking out of a price consolidation or a base pattern. The first time a stock retreats to the 50-day moving average, it can be an opportunity to buy it, especially if you missed the breakout, okay? And we also want to look for that pullback to be on lower volume. It just means that the stock is taking a breather. However, failure to get support at that line can be a sell signal. So how do you know the difference? All right, well, context is everything. Where is the stock in terms of its overall move? Are we early in the move, or is this after a long run that the stock has made? What is the overall market doing? Are we in a strong uptrend, or are we in a choppy environment? Are we early in a bull market run, or are we later in the cycle?
And again, like we mentioned earlier, you can think of these lines as lines of defense. Now, in a daily chart, the shorter-term line of defense will typically be the 10-day moving average. The next line would be the 50-day, and then from there, ultimately, the 200-day moving average. Although we have to say in most cases, you're going to be long gone from that stock by the time it gets down to the 200-day and then breaks it.
Oh, yes. Unless, of course, you've had this position for a very, very, very long time,
right,
like Apple, and for many reasons you're convinced that the stock will go higher, you could choose to hold. But the 200-day line, folks, is pretty far down there.
Now, for an example of how this works, let's take a look at Ambarella. The ticker is AMBA, and we'll have a chart for this on our website at investors.com/investing show. But you'll see on there that from around May 13th, the stock climbed very nicely right along the 10-day moving average until June 19th. And then it came down right to that 10-day line, and volume was rising and well above average. That's a sign that some selling, some short-term profit taking was going on. That was on a Friday, and the next trading day on Monday, June 22nd, Ambarella shot right below that 10-day line on even bigger volume. So that's a clear sign of some selling.
And if you look at the chart, that was a decisive little break. Now,
Absolutely.
we're talking about short-term breaks. There may be some people, again, that are still holding to Ambarella. But we're just talking about these different moving averages and some short-term indications. And that first real harsh break after it had made such a nice little climb, which was kind of climax in the way that it looked, when it came off of there, you could see that was a huge change in personality.
Absolutely. Clear change in trend, at least a short-term trend. Now, so far, Ambarella has stayed above the 50-day line. Again, the second line of defense is so far holding. So depending on whether you have a short-term or a longer-term approach to this particular stock, you may have decided to at least sell some of your position when it broke that 10-day line. But like Amy mentioned earlier, if you have a very large cushion in that stock, maybe you want to wait to see what it does at that next line of defense, in this case, the 50-day line.
And that will probably be decided when it reports earnings.
Right. Now, this is a personal choice. You decide how you're going to handle this stock. But what we want to emphasize here is that you can use these moving averages, the 10-day, 50-day, 200-day, as benchmarks to help you make that decision.
Now, Matt touched on the 10-day line, and I talk about this in my book, How to Make Money in Stock Success Stories. And it can be particularly helpful on a red-hot IPO, one of these ones that zooms higher in a pretty short period of time out of their IPO bases. I interviewed Mike Scott, who's a meetup leader in Thousand Oaks, and he profited from Michael Kors, and I show this in the book. And he bagged about a 74% profit on that first big break of the 10-day moving average. The 10-day line might have helped you with a few other stocks. For instance, Mobileye was up about 41% before breaking it. GoPro was up almost 96% before breaking through the 10-day. Now, I'm not talking about a little tiny dip below the line and it kind of holds tight right there. That's not what I'm talking about. We're talking about the very first decisive break of the 10-day. And usually this is going to be on a spike in red selling volume. And that indicates that investors are locking in some short-term gains.
And especially for these newer IPOs like Amy you're talking about, but really for any stock that you own, you want to have a defensive sell price in place. And there are many different ways that you can determine what that price is going to be. It comes down to a lot of different factors. But one way you can do it is to set your target sell price at around the moving average, whether it's the 10-day or the 50-day. So in other words, if the 10-day line, for example, is your first line of defense, you can decide that you're going to sell, say, 25 or 50% of your position, whatever it is, if the stock breaks below that line. Then the 50-day line could become your next line of defense. And again, the percentages and the prices, all of that is up to you, and it depends on your position in the stock, how the market is doing, how the stock's price and volume action is. But using these moving averages as benchmarks is extremely helpful, and it also helps you see what big institutional investors are doing with that stock. Are they in selling mode or are they in support mode?
And this goes along with, remember we talked about getting incrementally in and incrementally out. These moving averages can help you do that as you manage your portfolio. I was talking about the 10-day moving average line, and Vincent Mao wrote an Investor's Corner article, and he mentioned that shorter-term traders are focused on capturing smaller moves. Now, it depends. Again, Matt was talking about market conditions. One of the rules that Vincent writes into this article, he says, if a stock goes up 20 to 25% and then it breaks the 10-day, that might be a place to take some profits, all right? And this is one of our basic tenets of CAN-SUM investing anyway, which is that most stocks in a normal market, not in the current environment, but in a normal market, most stocks will run up 20 to 25%, and then they'll take a little breather. Another sell rule with the 10-day moving average is to sell if the stock has posted double-digit gains. And then after that, after the stock has really zoomed, if it then gets a downgrade or market conditions deteriorate, we move into a correction, you're taking some defensive action as the stock slices below the 10-day.
And again, the 10-day moving average is a very short-term benchmark that you can look at for the reasons that Amy just said. Now, for a longer-term approach, you're going to focus more on the 50-day, which is on the daily chart, or the 10-week, which is the equivalent on a weekly chart. And for an even longer look, you'll look at the 200-day line on the daily and the 40-week moving average on the weekly chart. Now, of course, in many or most cases, as we mentioned, you're probably going to be out of the stock by the time it reaches that 40-week mark and then drops below it on volume. But if you are holding a big winner over many months, maybe even several years, and you're sitting on a very large profit cushion, you may use that 40-week line as kind of a final line in the sand to see if it holds and you're going to stay in that stock or not. So we're going to take a quick break, and then we'll come back and talk about how to handle stocks that are way above this moving average and what it means when these lines cross either above or below each other.
So we're going to talk a little bit about the percentage of stock is above a certain moving average. Now, we have some monster winners. We're not going to put a certain number where you have to sell it. We're just going to bring about some stocks and show you some examples of they did shoot way up and they were way above the moving average line, and then they pulled back. It's just another little thing that you can take a look at that may alert you as to when you might want to pull out that defensive sell signal or have it ready in your back. Have it ready in your back pocket, because you know that a stock isn't going to go up forever.
What comes up at some point is going to pull back.
It comes back.
And when you get 50 or 100% above the 200-day moving average, it's due for a pullback at some point.
And in the level 2, what we teach is there's such a small percentage of stocks that go massively, above the 200-day moving average. I mean, it's just when you get up to those lofty levels, at some point you're going to correct. So let's talk about Keurig Green Mountain, and let's go back in time. The ticker here is GMCR. Let's go back to May 17th, 2013. The stock, I'm looking at the chart, what a huge move, had gorgeous earnings. It was 95% above the 40-week line. This is on a weekly chart. And it was 32% above the 10-week line. So you're starting to approach those levels of, getting 100% above the 200-day moving average. And then the stock did not fall apart, but it did pull back, and it formed a little base, and then it formed another base pattern. So it just had to digest some of those gains. So maybe you'll be alerted at that point if you're sitting on a huge gain that maybe just be careful when the stock gets that high above the moving average.
So just to kind of repeat what Amy just said, keep in mind that when Green Mountain got that high above the 40-week moving average line, it pulled back once, and when it did it again a few months later, it pulled back again. When you see a stock at that much above the 40-week moving average line, you really do have to start thinking, do I want to be greedy and just hold on for every last dollar, or do I want to at least lock in some of those profits, or at least have a price that says, at that point, I'm going to lock in X percentage of my gains?
Since we're looking at the chart here, each time the stock made a decisive move below the 50, it went on to either do a couple of things. It formed another base pattern here a couple of times, or it did finally fall apart and it began to live below the 50-day line or the 10-week line on a weekly chart. And so those can be some other things that you look at. Just go look at some of these winners from the past, and it will help you handle some of the good market winners that we're going to get again. Look at how they behave. Look at how they run up. Look at the percentage above the moving average line. Then they pull back, they form a base, and then what happens when they finally roll over?
Right. And like IBD founder Bill O'Neill always says, you have to know the personality of the stock that you're trading. And if you're in one of these high-flying, super aggressive growth stocks, these are the ones that get way above the 40-week moving average line. And they're also the ones that pull back sharply. And when a break comes, sometimes that break is very quick and very sharp. And you can see a significant loss of profits in your stock very quickly. And just think about why that is. This stock has broken out, made a major run in a short period of time, and now some of these large investors are taking their profits. So along the way, you just have to make that decision. At what point are you going to lock in some of your gains? Because you can give a lot of it back very quickly. Now, compare that kind of stock, like a Green Mountain or an Ambarella or a GoPro or some of these other ones, to stocks that are maybe more established, larger cap perhaps, and a little bit more controlled in their trading. One would be, for example, AmerisourceBergen, ABC, or O'Reilly Auto Parts, ORLY. All of these stocks have made good gains. They can be volatile like anything else, but you're not seeing the huge, quick, rapid growth in these larger stocks as you would in a newer, more aggressive growth stock.
And if you look at the Big Cap 20, which comes out in the IBD newspaper on Tuesdays, that's a good place if you just want these more stable names. So Matt is absolutely right. When you're in these more high-growth stocks, just know that they go up and they do pull back.
Sure. Now, Ambarella is another stock that we've been talking about a little bit today. It's another good example of how you can handle the relationship between the moving average lines. As I'm sure many of you know, Ambarella has been a very hot stock for a very long time. It's made a massive run. But then that began to change back in June. In the earlier segment, we were talking about looking at the daily chart and the 10-day and the 50-day. But if you step back and look at the weekly chart, you'd see that on June 19th of this year, Ambarella was 91% above the 40-week moving average, and it was about 34% above the 10-week moving average line. So at that point, and just go to our site and look at the chart, and imagine you're back in mid-June when this thing is just going up and up and up. It did have the signs of what we call a climax top. So at that point, again, you have to mentally think, do I want to be greedy and try to squeeze every last nickel out of this thing, or know that at some point it's going to pull back and you want to make sure that you lock in at least a chunk of your profits?
Now, I'll be the devil's advocate here, Matt, okay? I think if you got into this stock later in the move, you probably definitely were a seller. You saw a change in personality. On the daily chart, it was pretty dramatic. If you back yourself up a little bit, if you had bought and you were a much longer term holder, you bought it much longer.
You could even go back to, say, September of 2013 when it broke out of a double bottom. You were up a lot.
You were up a tremendous amount. And maybe you're taking a look at this and the stock has found support at the 50-day and it has found support at the 10-week line if you look at the weekly chart. You know, those are decisions then that you have to make. Are you willing to be a longer-term holder, or are you saying, you know what, I don't like the market's action, I don't like the way it's acting right now on a daily chart, and you get out. But if you have that in your head ahead of time, knowing that it was getting pretty far above that moving average line, you could have your plan in place.
Absolutely. We spent a whole show on this a few weeks ago talking about how if somebody asks you, should I sell this stock? There are so many factors that come into play, and a lot of them have to do with you and your position, so it's all relative. There is no simple answer, I should get out at this point, I should not get out at this point. It really depends on so many different things. But again, using these benchmark moving average lines is a big help to doing that because, again, we just want to keep emphasizing this. If you're holding that great stock that's way, way, way above the 10-week or the 40-week moving average line, probably a pullback is due, and you need to decide what you're going to do if that happens. Don't wait until it does happen, and then your emotions are going to kick in, and you may freeze when you certainly don't want to freeze.
Another thing to take a look at is when the 10-day rolls over and maybe goes below the 50-day. Okay, that's a definite sign of weakness, okay? And same thing if you have the 50 that starts to dip below the 200. On the other hand, what you can see is a reversal of this. And I know it's something that Bill O'Neill does look at. Bill O'Neill's the founder and the chairman of IBD. If the 50-day goes back up above the 200-day and then it starts to go rising back up, that means that there's been a change in...
It's renewed strength.
It's renewed strength again. So watching those crossovers, and right now, of course, on the indexes, we have some pretty ugly little crossovers.
Right. So again, when a shorter term moving average goes below a longer term one, that shows weakness. So if the 10-day goes below the 50-day, that is a sign of weakness. But on the reverse, when the 10-day comes back above the 50-day, that's a sign of renewed strength. And you will see that pretty often when a stock is forming the right side of a base, and it's a positive sign. This week I did an IBD stock analysis video on Lennar. The ticker is LEN. And if you look at the right side of the cup with handle that it formed, you'll see that that's exactly what happened. The 10-day got back above the 50-day moving average line. It's just one more indicator that says this thing is showing some renewed strength and it's worth taking a look at.
And I also covered Lennar in Market Wrap, and so we were looking at some similar things there.
Right.
So these are just key things that we look at that we hope will help you with your investing.
When you start investing, it's critical to have a game plan for success and a simple routine that fits your schedule. With Investors Business Daily, you get both. The Market Pulse shows you the right time to buy or move to the sidelines. Unique lists like the IBD 50 highlight stocks that could be on the verge of a big move. And IBD Stock Checkup gives you pass or fail ratings for any stock before you buy. Get a free trial at investors.com/radio show. That's investors.com/radio show.
Now, the final segment of How to Make Money in Stocks with Investors Business Daily.
We want to remind you that you can get show notes for this episode as well as markups for the charts that we've mentioned and links to the mutual fund report that I mentioned where you can see the latest buys by the top performing mutual funds. All of that at investors.com/investing show.
Okay, have a great week, everybody. See you next week.
You've been listening to How to Make Money in Stocks with Investors Business Daily, featuring Amy Smith and Matt Galgani. For more stock ideas and investing strategies, and to subscribe to the free podcast of this show, log on to investors.com/radio show. That's investors.com/radio show.